Look, in today's world, especially here in India, making sure our family is secure is, well, it's everything. That's why we're going to break down one of the simplest yet most powerful tools you can use to do exactly that: term insurance. Seriously, think of it as the ultimate financial safety net for the people you love.
We all know life can throw you some serious curveballs, but what if your family's financial security didn't have to be one of them? That's the big idea we're diving into today: how you can build a shield that protects their future no matter what happens.
So let's just start with a really direct question, and I want you to pause for a second and actually think about this. If your income just stopped tomorrow, could your family keep up with their lifestyle? Could they pay the bills and still chase their dreams? Answering this one question is exactly why this conversation is so incredibly important.
And let's be real, the financial pressure these days is no joke. High inflation is eating away at our savings. Education costs, they're just climbing higher and higher every year. I mean, some professional course fees have practically doubled in the last decade alone. And you know how it is. A single medical emergency can wipe out years of hard work. On top of all that, most of us are juggling things like home and car loans. These challenges make a financial safety net not just a nice to have, but an absolute necessity.
Okay, so we've laid out the problem, right? Now let's talk about the solution. And the great news is, it's actually surprisingly simple and incredibly powerful. So let's get right into it. What is term insurance, really?
At its core, term insurance is the purest form of life insurance you can get. There are no complicated investments tied to it. It has one single job, and it does that job brilliantly. It provides a large, tax-free sum of money to your family if you're no longer there to provide for them yourself. Simple as that.
So how does this actually play out? Let's take a look at an example. Let's say we have Rahul. He's 30 years old and he buys a 1 crore rupee plan that covers him for the next 30 years. For this protection, he pays a small premium every year. Now, if anything were to happen to him during that 30-year window, his family gets the full 1 crore. But if he lives past the 30-year term, the policy just ends. That's it. That's the elegant simplicity of it all.
And that brings us to a really crucial point: the trade-off. You're probably wondering, how can such a huge amount of coverage be so affordable? Well, the answer is simple. You aren't paying for any investment returns. You are paying purely for protection. And that's the magic that keeps the premium so low.
All right, so we know what it is. The next massive question is, how much coverage is actually enough? This is where we get practical and start figuring out the right number for you and your family.
A really good rule of thumb, just as a starting point, is this: aim for a cover that's at least 10 to 20 times what you make in a year. So for instance, if you earn 7 lakh a year, you should probably be looking at coverage somewhere in the ballpark of 70 lakh to 1.4 crore rupees.
But, a simple rule is never the whole story, is it? That's just the tip of the iceberg. To build a truly rock-solid safety net, we've got to dig a little deeper.
So to get the full picture, your coverage needs to be big enough to do 4 key things. It needs to pay off all your loans, home, personal, car, you name it. It needs to fund your kids' education down the road. It has to cover your family's day-to-day living expenses. And finally, it needs a little extra buffer for inflation and those unexpected emergencies. You add all that up, and that's the number that truly protects them.
So once you've got your number, the next step is jumping into the market. And yeah, there are a lot of options out there. So how do you even begin to compare plans and make sure you're picking the right one?
Here are the big things to look for. First up, the claim settlement ratio. You want to see a number above 95%. This basically tells you how likely the company is to actually approve a claim. Super important. Next, check the policy term. Make sure it covers you until you're at least 60, right through your main earning years. Then you might want to look at riders. Think of these as optional add-ons, like extra protection for a critical illness. And finally, of course, check out the insurer's reputation. You want a company that people trust to make the process smooth when it matters most.
For example, you've got popular plans like HDFC Life's Click to Protect. It's really well known for being flexible. It gives your family different ways to receive the payout, which can be a huge help in managing a large sum of money.
Then there's something like Max Life Smart Secure Plus. Its big selling point is a very, very high claim settlement ratio. So that ties right back to that key factor of reliability we were just talking about.
And another big one is ICICI Prudential's iProtect Smart. This one is a really strong choice if you're looking for comprehensive coverage, especially since it often includes protection for critical illnesses.
All right, we're almost there. Let's finish up with a really crucial step: avoiding the common mistakes. Getting these few simple things right can make all the difference,
And it'll ensure your policy does exactly what it's supposed to do when your family really needs it.
Okay, this is probably the biggest mistake people make. Hiding medical info or smoking habits to try and get a lower premium. Don't do it. The smart move always is 100% honest disclosure. Because if you don't, you run the risk of the insurer flat out rejecting the claim later on, which, well, it defeats the entire purpose of having the policy in the first place.
Here's another common trap: choosing a low coverage amount just to save a little bit on the premium. It's tempting, I get it, but remember that calculation we talked about. The smart move is to make absolutely sure the cover is truly enough for your family's needs. The whole goal here is protection, not just getting the lowest price tag.
And finally, a really simple one. Don't wait. The longer you put it off, the higher your premiums are going to be, period. The smartest move you can possibly make is to get a plan when you're young and healthy. You'll lock in a much lower premium for decades to come. So as you can see, securing your family's financial future, it doesn't have to be some huge, complicated thing. It really all comes down to one clear, informed decision. The only question left is,